Hello, everyone. Going to take a few minutes to talk about budgets today. So let me open up the Excel sheet here. Okay, so um, budgets are something that basically pretty much any area of business you're going to see. If you work in management, if you own your own business, work in accounting, marketing, you're going to see budgets. You're going to have to work with budgets, even from a personal basis. It's very helpful to have a personal financial budget. So budgets are something you're going to see. Now, some benefits of budgeting. They're great for planning because think about it this way. If you anticipate having a really good year next year, you can add extra materials, extra inventory, extra employees. If you're having a bad year or the economic, recession or expect business to go down, you can also plan for that. So by less inventory, less employees, less cost in some areas. So budgets are a very good tool for planning based on the level of business that you anticipate. Now, they're also very good for control, which means that you can use them to help control cost, to keep cost within acceptable limits. They are very good for that. Also good as a communication tool. Basically, budgets can be used to communicate goals throughout the company. They can also be used for coordination, in that a company can, allocate resources through the use of the budget. Departments that need more resources, that are anticipating higher levels of business, can get more. Those that are maybe having business stay the same or business drop will get the same or less. So it's a way to coordinate the use of resources best across an organization. And motivation. Basically, whatever you're given, if you manage a unit of a company and you're given a goal, or you're given a budget total that's expected of your unit, then you need to, that should motivate you to meet that goal. Because basically, if the budget says that your department's to do 100,000, then that is what the company expects of you to do. So it can act as a motivation tool, and oftentimes is used basically to determine bonuses, and a major part of many performance evaluations as well. Now, some types of budgets. Basically, you have participative budgets. This is kind of a bottom-up budget. A participative budget is a type of budget that starts at the bottom of the company and basically works its way to the top. The different departments at the bottom will basically come up with the numbers for their area, pass it on to their supervisor, who will then pass it on to the supervisor above them, and the numbers just work their way to the top. And so a participative budget is good if it's done right, because it involves more people are understanding of the budget and what's expected of them. So if it's done right, this could be a very good way to do budget. Now, one thing I will say, I'll jump down to one of the terms down here, budgetary slack, real quick, because budgetary slack is very much related to participative budgeting, in that a lot of times as the budget moves forward, different parts of the company may give themselves a little slack, or cut back their numbers a little bit in order to give them a little slack to meet the budget. So this is something that management does anticipate sometimes, and will sometimes adjust numbers if they fear like there might be some budgetary slack involved. So that does go along sometimes with participative budget. You got a top-down budget, which is just upper level management says, this is what we expect, go make it happen. Sometimes that's an easier way. I will say this because you kind of know up front, okay, this is what's expected. We don't have to go through all the processes and formulations of the budget. So I will admit sometimes that's easier. You've got a zero-based budget, which a zero-based budget is probably the best budget, or it eliminates more issues within the budget than other types of budgets. Basically, a zero-based budget, every department starts with zero, and has to explain why they need so many employees or why they need certain travel budgets or expense budgets. They basically have to explain it every year. And if they can't explain it, then they don't get it. If I'm managing an accounting department and we've got 7 employees, then if I can't explain, if I can only explain the need for 6, then I'm going to lose an employee. And so I think the big advantage of zero-based budgets is that they kind of keep budget or operational issues from just being kind of kicked down the road, because you're looking at things like that every year. So if there are updates made to the system or certain things are audited and an area no longer needs as many employees as they have, the company can then take them away from that area and maybe give them to an area that needs them more. So it's one of those things that I think it is more accurate. And like I said, I think it keeps certain operational issues from kind of the can getting kicked down the road. The downside is it takes more time and effort. And so that would probably be the downside to it. Now, you also have continuous or rolling budgets. And what these are is these are budgets that you constantly have 12 months or 4 quarters out. And every time a month ends, a new month, begins, or a new month comes on to is added to the end. Every time a quarter ends, a new quarter is added to the other end. So you've always got 12 months or 4 quarters out there. This tends to be a little bit more accurate because you're updating the numbers more often. The only downside is you tend to have to visit the budget more often, and it does take more time. So that would probably kind of be the downside to it. Now, a few companies in recent years have decided to move away from budgets. And what they do is basically they set goals. And so when they set goals, what they do is, like, there is a goal to maybe financial ratios or something. And they do this as basically setting goals instead of working to the budget. And the reason that they've decided to do this, a few companies have, is because they just realized how much time budgets can take. And so basically they've reduced that time that their employees spend on budgets by just implementing goals, which are easier and much quicker to implement. They still act as ways to judge business performance or to evaluate business performance. It's just they can be much easier to calculate and work with rather than full-scale budgets. So now let's talk about the master budget. So the master budget is kind of a series of budgets that all work together and flow into the budgeted financial statements. So the master budget always starts with the sales budget. And I've kind of got an order of kind of how they flow through this process here. So the sales budget. And it always starts with sales because sales is the biggest driver of expenses across an organization. So it always starts with the sales budget. Then it would flow through the production budget. And the production budget basically is just based on how much we're going to sell, how much do we need to produce. So again, sales to production. And then once we find out how much we need to produce, then it flows to the direct materials, direct labor, and factory overhead budgets. Now, the direct materials budget just looks at, okay, if we're going to produce this much, how much materials do we need to have on hand to produce it? And the direct labor looks at, okay, if we're going to produce this much, how much labor cost are we going to incur to produce that much? And finally, factory overhead, if we're going to produce this much, how much factory overhead cost are we going to incur? And then finally, the cash budget here, everything kind of flows down to the cash budget, which looks at kind of your cash coming in and your cash going out, and what is our cash position. Now, also what flows into the cash budget is capital expenditures, which this is a budget that looks at basically very large expenditures or money that's being set aside for large expenditures like a new plant in the future. And also selling general administrative budget, which this would be a budget of everything outside of manufacturing. So these two budgets also flow into the cash budget along with the flow down from sales, production, direct materials, direct labor, and factory overhead. Now, From here, it flows down to the budgeted financial statements. And you would get a budgeted income statement, budgeted balance sheet, and a budgeted statement of cash flows. Now, typically with the budgeted income statement here, if everything flows down and you get the numbers like the net income on the budgeted income statement that management expects, then you've got a good budget. Typically, they'll sign off on it. But if everything flows down to the budgeted income statement, you don't get the number that management's expecting, many times that'll mean the budget will get kicked out and you've got to go back and revisit or find or eliminate some expenses to get to income numbers that upper level management was expecting. So this is the master budget, and it's a flow down to the budgeted financial statements, basically. Now, let's look at a few of the basic budgets. Now, we've got a sales budget, and the sales budget would just be your sales in units times your unit selling price for your total sales dollars. So companies put a lot into their sales budget because if you've got a good sales budget, that's the real driver of cost across the company. There's a much greater chance that you'll have an more accurate budget overall. So companies put a lot into the sales budget, but the sales budget is basically just how many units that you expect to sell times the selling price equals your total sales in sales dollars. Now, the production budget starts with the sales in units. So again, sales first, production second. Again, there's a flow of numbers throughout the different budgets. The production budget would just be how many units do you expect to sell, plus your desired ending inventory. And desired ending inventory is something that every company has to come up with. And every company desires a certain amount of extra inventory on hand. Some desire more than others. It would really be up to the company. I think in today's world, it is important to have a little bit of extra inventory, especially with the issues in the supply chain that could come up, or anything that could hurt new inventory items coming in. If you've got a little back stock, it can kind of get you through those times. So projected sales plus desired ending inventory equals the total units available less the beginning inventory. And we're subtracting out beginning inventory here because if we've already got it, we don't have to produce it. And so we subtract out what we've already produced, and this is the amount of required production that we need in order to meet our sales goals for the period. So in this case, we need to produce 11,000 units in order to meet all of our goals for sales and our level of desired inventory. Direct materials budget. The direct materials budget, again, comes right off the production budget. You see required production is the first level here, and you see required production is what ends the production budget. So the direct material budget is going to look at, in order to produce 11,000 units in this case, how much materials do we need and how much is it going to cost us? So here's basically the format. You would take your required production times your direct materials per unit to get total direct materials needed. You would add your desired ending inventory. Again, this would be up to the company to decide what they felt like was a good kind of extra inventory to keep on hand. This gives us our total material needs. We back out what we had in beginning inventory to give us our direct materials to be purchased times the purchase price per pound gives us our direct materials, or what it's going to cost us, to purchase the direct materials that we need. Now, the direct labor budget is also based off the production budget. You see here required production, which ends the production budget, begins the direct labor budget. Now, the direct labor budget, or the purpose of the direct labor budget, is to tell us if we're going to produce this many units, or whatever comes, or the number that's on the production budget, we're going to produce this many units. What is it? How many hours is that going to take us? And what is going to be our direct labor costs related to that level of production? So in this case, we take the units that we're going to produce times the number of hours per unit it takes to produce them. and we get 5,500 direct labor hours. Then we take that times our direct labor rate per hour and 15, and of course this would be up to the company, and that gives us our total direct labor cost, which is 82,500. So it would cost us $82,500 to produce of direct labor cost to produce 11,000 units. Now, one thing I did want to show you real quick as an example is sometimes you will see these budgets in quarters. I was showing them to you basically by years here in the first examples, but I want to show you what they would look like if they were done by quarters. So I've got a sales budget here, and notice you have first quarter, second quarter, third quarter, fourth quarter, and then a total out here. Now, notice that they're really the same thing that what we looked at earlier with the sales budget. And that for each quarter, it would be the number of units we expect to sell times the selling price, gives us our total dollar value of sales. And you would see that in every quarter, and then you would see that total for the year here at the end. So now a production budget in quarters is a little different, and kind of I want to explain out how it's going to be different. The format is basically going to be the same. You're going to have your units sold, which again comes right off the sales or the projected sales in units for that quarter. Then you're going to add desired ending inventory. You're going to get your total production needs minus what you've already got in beginning inventory. And this is how many units you need to produce during this quarter. So the formula is the same, but a couple of things I do want to point out when you do this one on a quarterly basis is that many times you'll see it as basically your desired ending inventory will be a certain percentage of the next quarter sales. Like in this example here, I put 20%. So what that means is that your desired ending inventory in the first quarter is going to be 20%, in this case, of your units sold in the second quarter, which is 6,000. You're in the second quarter, your desired ending inventory is going to be 20% of the next quarter sales, which are 8,000. And then in the third quarter, your desired ending inventory is 20% of your sales in the fourth quarter. Now, this number here basically was just given, or you might see a problem give you the first quarter for the following year projected sales. And the other thing I kind of want to point out is typically the ending inventory in one quarter is the beginning inventory in the next one. And you see that in here. Now, see, because think about it this way, whatever you end the first quarter with is what you begin the second quarter with. Whatever you end the second quarter with is what you begin the third quarter with. Whatever you end the third quarter with is what you begin the fourth quarter with. So those are things that you do tend to see that's a little bit different about the production budget when it's done by quarter. Now, the formula is still the same. It's still calculated the same. The purpose is still the same, but you will tend to see that that is a little different when you see it by quarter. And the same thing, and you would kind of follow the same format if you were doing the direct materials budget or the direct labor budget in relation to them being done quarterly. Now, let's do a schedule of, let's look at the schedule of cash receipts. Now, the schedule of cash receipts, basically, it's kind of part of the cash budget. And they do one for cash receipts and for cash disbursements. And they kind of look at the cash position of the company. So what the schedule of cash receipts looks at is based on the sales that we're making and based on the kind of anticipated schedule of cash collections. How much cash do we have coming in during a month or fiscal period? So notice here that we're given sales for the month of November, December, January, February, and March. And notice that we're given kind of a schedule of cash collections here. The company collects 60% in the month of sale, 30% month after sale, and 10% 2 months after the sale. Now, these numbers here would be collected by the company, and they would basically just be numbers that the company would use, or the companies that the numbers are, excuse me, numbers that the company comes up with, typically just based on past experience. So if past experience says we collect about 60% month of sale and 30% month after the sale and 10% 2 months down the road, then that's basically how they're going to set up their schedule of cash collections. This might be something that they revisit often, because as the economy changes, this could also change. So let's look at an example of this. Let's say that we had sales. So let's look at, we're going to look at how much cash has been received by the company for the month of January, February, and March. So what we'd do here is we'd look at, for the month of January, we receive 60%, we receive collections of 60% of sales within that month. So we sold 80,000 in the month of January. We collect 60% month of sale. So we would take 80,000 times 60%, and we would get 48,000. We collect 30% month after the sale. So we would take 30% of December sales, and that's what we would collect in January from December sales. And then we would collect 10% 2 months after the sale. So in January, we would collect 10% of sales in November, which was 2 months ago. We add this up and we would collect 103,000 cash in January on sales from the current month, prior month, and 2 months prior. Now we'd come to February. And again, 60% of the current month sales would be collected in the current month. So we would collect 66,000 in cash from sales made in February in the current month. We would collect 30% of sales from the prior month. So 30% times January sales total gives us 24. 10% 2 months down the road. So we'd collect 10% of December sales in the month of February. Add that up and we'd bring in $105,000. Now in March, we're going to collect 60% of sales in the current month. We're going to collect 30% of sales from the prior month, which would be February, and 10% from 2 months ago, which would be of January sales here. And we would collect 119,000 in March. So schedule of cash receipts is very important because it looks at, based on how much cash do you expect to receive in a given month or in a given quarter. And it's important because you're going to look at this in comparison with your cash disbursements to see, are there times that you need to borrow or pull from a line of credit, or you just kind of want to make sure your cash position is solid where you've got the cash to pay your bills. And so this is really just part of cash management and making sure you've got enough cash on hand to pay your own bills as you need to. So again, this is just part of the budget, but it's part of managing cash in the cash budget. So so this is budgets, or some of the main points, or some of the kind of key points of budgets. So have a great day and talk to you soon.